Xerox that I don't know if that company is alive, but that was a darling. That was a great new machine. And of course, now BlackBerry, who didn't have a BlackBerry 20 years ago and who has now, I'm not sure. But you're right that the new paradigm is such a funny word when you hear AI and new paradigm and you're thinking, I think I've heard that before. I think I heard it back in the 90s. And the internet did change things, but it wasn't without some crazy volatility along the way. And be careful when you hear a new paradigm, because it's not new. There have been paradigms all along the way, and I'm sure there will be another one too.
Imagine it's 12 months from now, and you've achieved your major life goals. How does it feel to be in the best shape of your life? To wake up energized, excited about the day? To have great relationships and friends who support you and propel you forward? How does it feel to have an excess of money? To be able to make the choices you want? To be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time, and your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. Welcome to Rich Your Soul, where we achieve our dreams and bring balance to health, wealth, relationships, time, and spirituality. If you have not had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Rich Your Soul and how to create the life of your dreams. You can also find all the show notes for this episode at richyoursoul.com. Hey, it's Rocky. Welcome to Rich Your Soul. Today's guest is Mick Heyman, who will teach us to chill with our money. Today, we're going to start with 2 quotes that come from our guest's book. The first is by G.K. Chesterton. Doing nothing is sometimes one of the highest of the duties of man. The second is from Benjamin Graham. The investor's chief problem and his worst enemy is likely to be himself. In the end, how your investments behave is much less important than how you behave. You know, it's funny because they did studies and they found that people who don't do anything with their investments and leave them alone actually have better returns than people who are always messing with them. And there's nothing wrong with sitting on cash. As a matter of fact, I was just reading Warren Buffett sitting on more than $150 billion just waiting. Pretty impressive. Our guest has over 40 years of experience in wealth management. He's helped countless individuals and institutions build and preserve wealth using his stress-free method for mellowing your money. He's appeared in the Wall Street Journal and other major financial publications to share his insights. Today, he's going to draw on his lessons from his extensive career to provide a thoughtful perspective on avoiding common money mistakes, managing our emotions around the market, and cultivating resilience in turbulent times. He'll share his current outlook on the economy and some key indicators that he's monitoring, and some of the pivotal life experiences that helped him come up with his philosophy about money and investing. He also talks about life beyond the money, right? Sharing humanity. And I think you'll enjoy that as well. Let's meet Mick and learn more about him. Welcome to Rich Your Soul, Mick Heyman. It's great to have you join us today.
Thank you so much, Rocky. I'm excited to be here.
And I'm excited to learn from you. We always like to start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
It's funny when I think about it, most of the lessons I learned from my family and from school, it almost took me years and years later to actually learn the lesson that I was learning as a kid, let's say. And most of them were through challenges I was going through. For example, and this is not necessarily about money, I had trouble speaking growing up. And so it took me a few years. I was 3 or 4 when most kids were speaking at 2. And ironically, it was only 25 years later that I found myself in a job where I had to speak. I had to give presentations. And overcoming that gave me such freedom that I never realized that overcoming that challenge was a gift in life. Same thing when I think of my father. My dad was a very strong and important lawyer in Dayton, Ohio, where I grew up. And everybody would always say how he was helping them, and both in volunteer work and work he was doing as a lawyer. But at home, he was tired and he was frustrated. And we ended up, as a teenager, had these pretty competitive tennis games with him that it was like a war. And if I lost, it felt like life was coming to an end. And it didn't lead to this great connection until years later. And I was going through a failed marriage, and where I kept talking about, gosh, I want to talk about this relationship. The therapist kept saying, no, it's about your dad. And until you overcome the feelings you had with your dad, you're not going to get through anything. And so it was all about competition and living up to expectations. And when I finally faced that with my dad, found out that he's really a loving man who was going through a troubled marriage on his own. And once we achieved that, again, there was this freedom, this willingness to kind of look at life differently and to look at money differently. All of a sudden, I didn't need to compete with those around me as much. I could look at the market and not compete with the market. Of course, try to compete with the market, you're going to fail every time. But those were some of the lessons. And then when you specifically look at education, I had a teacher probably in high school who taught me to love to write. And I love to write, but I got intimidated in college and put that away for 40 years until recently when I was able to finally say, forget it. I want to write and create. And here comes the book. But one of the funniest things was, you think of an investment guy as a numbers guy. And I majored in economics, and you were forced to take statistics. And after the first midterm, I remember the teacher taking me aside and saying, I know you don't know much about statistics, Mick, but let's figure out the odds of passing this course after this midterm grade. And after looking at that, he smiles and says, go to the drop office. And of course, eventually I passed statistics, but realized that was not my path. And ironically, my favorite course in college was Russian literature, and in particular, learning about Dostoevsky. And what were you studying there? Emotions. And when did I think that would come into important part of my life? But that's what the market is. The market moves on emotions. And so, a lot of these lessons I found growing up, it was later on that came to roost to kind of help me through the money part of life.
And we've done episodes in the past where we talk about emotions in investing. We talk about the psychology of money. All of these things all come together. The hard facts of money are actually pretty easy. It's mastering yourself and the way you behave with money is a whole different story. And I know because I've made a crap ton of mistakes over the years with investing and in doing a lot of the different things. But I had the math down right. So I could figure that part out. But a lot of the rest of it is very, very difficult. And most people find it difficult.
And having that humility, though, is so important because it's through those mistakes that you can learn your lessons. And if you look at it and blame the Fed or the president or Congress or something else and don't look inward, you're not going to learn. You're not going to be able to move forward. And so it's really learning from our mistakes and our experiences that can teach us how to get in touch with those emotions a little better and take those steps. You're right. If you read you just Google how to invest, and there's 5 steps, 7 steps, and you read them through and you say, oh yeah, that's pretty easy. I just have to do that. Well, then the pandemic comes and you throw those rules out the window and you do something else if you're not in touch with your emotions.
What % of people do you think are in touch with their emotions when it comes to money?
I think, when you look around, it's got to be in the 1 out of 10, 2 out of 10. Of course, I've just told you statistics is not my greatest strength. I would say it's 20% would be high, and most people are trying to outsmart the money, and probably some of those people may not be in touch with their emotions, but hopefully they're lucky enough to not pay attention so much, and by accident they're doing okay if they're not being too active.
Not surprising at all. I think it's a small percentage overall that get it down. And I think that's why most people go on the roller coaster of the markets and roller coasters of money. And, even people who are successful can lose it all too. And it goes up and down time and time again.
No question. And I think especially the people you read about who lose sometimes the most public figures, the problem there is that it's a different skill oftentimes to make money than to save it. And sometimes you look at people who run corporations or are in the entertainment business, and the things that got them success were their ego, were their confidence, and how they were able to press forward and take risks and do all these things. And the problem is you transfer that skill to saving money. It's the wrong path. And so that's part of the problem too.
Making money is a very different skill than keeping money. And
exactly.
Not many people have both.
Right.
And that is the issue. And that is kind of the key. And honestly, I think the better of the two skills is keeping money. Because if you can keep money, even if you don't make a lot over time, you can win the race, right? It's the hare versus the tortoise. It's the keeping it and allowing it to compound that is truly what wins.
Now, I think both externally, the people who can do that can slowly accumulate and have everything they need. Maybe it's not as huge as some other people's pile of money, but they've got everything they need. And that balance in life is going to give them happiness. Whereas that roller coaster can only lead to a lot of pain.
It can. So what got you into the world of investing?
Well, it's funny that it was not a planned thing. It was a summer internship that back in the days, the 70s was a terrible time. And that's about the time I got into the business in 1980. And if you look back at the 70s for stocks, I think the Dow Jones was up at 5% for the entire decade. It was gold, it was oil, it was real estate. And so I got this summer internship, and they eventually offered me a job. It was four old partners, and they thought they needed a kid. And people looked at me and said, kind of sideways, "Are you sure? This stock thing is not a for sure thing." But what I loved about it was a small firm in Cincinnati, and we were helping oftentimes wealthy people. And it became kind of as opposed to my first impulse, which was, God, I wanted to be on Louis Rukeyser, who was the big Wall Street Week guy. And I wanted to be this great magician but the idea of just helping people appealed to me. And then over time, I learned that my skills of trading or making money through that were not that good. But my skills of investing for the long term were not bad. And so as I learned those lessons, and kind of as you were saying, you don't learn those lessons from reading, you learn it from losing money. And so by taking those lessons, I became kind of excited about that balance of helping people on the one hand and investing and doing this thing that a lot of people were failing at, but by sticking to the long term, I found myself all of a sudden being very successful. One of my first clients was a wealthy old woman who loved having company, and she invited me to spend every Monday evening with her, writing checks to charities and such. And she had these stocks that were bought in the 30s. And so huge capital gains. There again, you could not do anything. And we used to nickname that our strategy of benign neglect. We weren't, we weren't neglecting LOEs, but we were not trading the portfolio. And we found that portfolio outperforming all the other portfolios that we were trying to move in and out of. And so that was my first lesson, kind of a combined thing of helping someone over time, but also learning that investing is more about being patient than all this trading.
The 30s was a good time to buy stock. After the crash of 29, things were cheap.
If you had money, you could do it. But of course, that was the problem for most people back then.
I wasn't alive, so I have no idea. I know money was tight, but somebody had to have, right? Was everybody broke? Or, there were still people making money.
There were people still selling cars. And I actually had an uncle who at some point owned the Cincinnati Reds, lost the team in the Depression, lost everything, and had to come back selling cars and selling insurance. And he was one of those that started buying some stocks slowly and little by little. And you're right. And actually, that reminds me of one of my first assignments back at my firm was to go back and collect this data to put in the computer. You didn't have the internet. To, Mick, go to the library and get this data back out of old barons and such. And what I remember is as I'm writing the data down each week, I'm also reading the headlines. And it was amazing to me how every few weeks it looked like the world was coming to an end. And then you'd read the next week and, well, that didn't happen. And then things turned out okay. And then you had Pearl Harbor and you think, oh my God, that's what people were reading. And that's what they were thinking. And guess what? Pearl Harbor was almost the bottom of the market and at the top. And so over time, what that was probably one of my greatest history lessons of all time, just reading headlines going back to the 30s, because you realize the problems we're having now and a lot of the things that we're worrying about now, we feel are special and different. And of course, the actual things are different. They didn't have AI and the internet and all the different things, but they still had challenges to overcome that seemed impossible. And so that in itself gave me this feeling that if you're patient, things tend to work out in America.
They do, and they have worked out well. And it's funny because I know when COVID hit, people were like, oh, these poor kids, they don't get to graduate, and it's never been like this. And I'm like, are you kidding me? If you went back 60 years, those poor kids were going for the draft in Vietnam, and they didn't want to graduate. They had no desire. Like, the world wasn't so nice back then. So, having to be stuck at home and take classes on a computer screen isn't the end of the world, right? They all want to stay home and game anyway. So whoop-de-doo-dah.
They seemed, and I had a 20-year-old at that time, and when I was going to sleep at 10 or 11 o'clock, he was heading to the garage to play Xbox with his buddies, and it wasn't the end of the world. And people were saying, "Oh my God, this is now," like you say, this has never happened before. Gosh, 9/11, we didn't know what would happen after that, and there are constantly these surprises that come out of the blue, and we don't know what the next one will be, but we know there is the next one. There's something.
And the markets were closed. Was it the entire week after 9/11 or just 4 days?
I want to say it was the entire week, but I'm not sure about that. But it was a while when you wished it was still closed. It was not fun.
No, but we were also coming off of the ridiculousness of the internet bubble. The markets had already been dropping forever. And that was kind of the last straw, so to speak. And then things turned around in 2003, and boy, did they run.
Exactly. Much to everyone's surprise.
Well, and that's what it comes down to. It's you never know what's going to happen and how it all comes together. So what inspired you to write the book, Mellow Your Money, How to Surf the Market and Build Wealth Without Stressing Yourself Out?
It was really, I'd written a few blogs and some stories about some of these experiences and lessons. And what I thought of is my favorite book on investing was written about 100 years ago by Jesse Livermore. I think he wrote it under a ghost name of Edwin Lefevre, but called Reminiscences of a Stock Operator. And if you look at famous quotes on investing, it's peppered with a lot of quotes from his book. And think of that, 100 years ago when the market was, most people were trading not with live stock prices. They had to be wired and it was, sometimes minutes or a long time afterwards. But imagine that the lessons he was learning on emotions were so similar to what we're facing today. The lessons that he was talking about were similar. And so, not that I want to try to be Jesse Livermore or anything like that, but what I felt was the experiences that I had in helping people invest with a long-term focus, helping to kind of calm their emotions. I just wanted to be able to write and hopefully help people calm down, invest for the long term, and kind of take this craziness that we get every day with people telling you to, the recession is coming or this is happening, and getting people to buy or sell or worry about this. And I think there's a lot more that we can focus in on our lives if we kind of take care of the investing part, kind of put it to bed a little bit. Doesn't mean we never pay attention, and then focus on other parts of our lives. And so that was kind of both the mellow your money, and then having moved to California, I learned a few lessons out in the water, trying to learn how to surf and almost drowning out there, and thinking as I'm going under, and finally someone pointed to the shore and said, "Turn your board around." And I'm thinking, just look to the shore. And I'm thinking, what a lesson that is on investing. There could be crazy waves and everything else, but go back to your objectives. And so, the surfing part of it, although my kids would hardly say I'm a surfer, I go out in small waves and when the water's calm, but even that taught me a lot of lessons and kind of gave me the impetus for the title and the book.
And I think most of the times it isn't calm. Regardless, I shouldn't say it isn't calm. It's just that Louis Rukeyser isn't on the TV anymore. Instead, you've got Kramer, and all he's doing is screaming and yelling, no matter what's happening today. He's making you think that everything is going crazy.
And we ought to be doing something. I mean, he obviously is popular and has some interesting ideas along the way, too. I'm not saying that, but I'm getting people to even that 24-hour cycle that, after Kramer, there's someone else and there's someone else and there's a panel and they all have different ideas. And gosh, you could get lost in it all when someone else is, got their objective of maybe it's 60% or 70 or whatever they're comfortable with in stocks, and they're listening to you instead. And what a better thing to do, I think.
It's funny. People don't listen to Warren Buffett much. I mean, they do, but they don't. And they surely don't follow his advice very much. But he is probably one of the best stock market investors over time compared to anybody.
He's done a fantastic job, and he's done it by kind of staying true to his beliefs. He loves to look at companies and understand what he owns and invest for the long term. And he'll be, I'm sure, the first to admit that sometimes it didn't work out and you got to move away. But for the most part, if you stick to the companies that you know and like and are survivors, you're going to do okay. And, then that's part of the thing. I never saw in his portfolio Woolworth or Xerox or some of these companies that are no longer with us, but occasionally he'll get a dud, but he moves away. But the ones he likes are survivors, and then he doesn't have to trade them. And so a lot of the wisdom of Warren Buffett is if people just listen to that and focused on things they know, there's every cycle, there's something. In the 90s, there were Beanie Babies. That was the excitement. Now there's cryptocurrency, and some of these things may work out. I thought Amazon was a bookstore. And of course, that turned out to be pretty spectacular. But you have time. You don't have to jump on every craze. You had time to buy Amazon 10 years later and still make a lot of money on it.
I don't know how many people actually look at the earnings reports, look at the balance sheets. And the problem today is they play so many games with it that you don't even know if the numbers you're looking at are real. And that creates a whole nother issue. And then the other thing is things change overnight. And so you don't really know how that change can change everything. I think the latest one to hit the markets overnight change is ChatGPT, right? AI has caused markets to go wild in a particular area. Who knew that Elon Musk was going to come out with an electric car that was going to change the markets?
And it's going to keep happening, and it has always happened. Xerox, that I don't know if that company is alive, but that was a darling. That was a great new machine. And of course, now, BlackBerry. I mean, who didn't have a BlackBerry 20 years ago, and who has now? I'm not sure. But you're right that the new paradigm is such a funny word when you hear AI and new paradigm, and you're thinking, I think I've heard that before. I think I heard it back in the 90s, and the internet did change things, but it wasn't without some crazy volatility along the way. And be careful when you hear a new paradigm, because it's not new. There have been paradigms all along the way, and I'm sure there will be another one too.
Have you had any ahas since the book was published?
That's a good question. I'm trying to think. Well, one of them, and I guess, is I've always been a fairly private person. I have a small investment company. I did work for an institutional firm and gave presentations and had a lot of institutional clients where you spoke in front of a committee. But when you looked at my private life, hey, I've several really good friends, and I've got 3 kids. And so it's not like I'm huddled alone. But when you actually write a book and you get your name out there and you talk to, you have podcasts with Rocky, and all of a sudden you're more of a public person, that in itself was a challenge for me. All of a sudden it was like, you're opening up yourself to the world. And so, one thing I'd say is, I'm 65 years old. And if someone had told me back when I was 18, you're going to be challenged when you're 65. It's not going to be just roll over and retire. You're going to, it's not over until it's over. And my dad is 92 and he still works for clients and as a lawyer and is engaged in life. And so at 65, this is my challenge, being more of a public out in the world kind of person. And I believe in 75, there will be something else, that it never stops.
Well, and that's why retirement kind of sucks, right?
I think that some people, that's their dream, is to sit back but I think for most people, if you want to actually stay happy and engaged, even if you retire from a job you've been working at for 30 years, it doesn't have to stop. There's always the next thing. And reminds me of a story that's in my book. It's about my mom, who was going through cancer, and she, having only supposed to survive 2 to 4 years, ended up living 30 years. It wasn't always a pleasant 30 years. There were a lot of challenges and broken bones that she went through. And at one point, she came down to see us, and we had just had our second child, and she came in and immediately goes to the bathroom, and My stepdad is saying it was terrible drive. She suffered the whole way. It just looked like, this is near the end. And she comes out and holds my son and has this moment of just a wonderful look on her face. She's so happy. She gives the son over to me and says, well, that's it. I'm done. That's all I wanted. I'm through. And there's a long pause, and we're all understand what she's talking about. This is done. She's moving on. Let her go. And then she looks at this plate of chocolate chip cookies on the side, and she says, except for that one little cookie over there. And then we start laughing, and we think, that's how life is. There's always the next cookie, and so anyway, that makes me think, even with retired folks, there's always the next thing to learn.
Today's episode is sponsored by Profit Answer Man Podcast. Did you know that most small business owners hate looking at their financials? It's one reason they may struggle with business success. The Profit Answer Man podcast helps them ensure they are profitable and can pay their employees and weather the storms we all have to face. It's built on the Profit First methodology of pay yourself first. The Profit Answer Man podcast is a must listen to for every small business owner and anyone who wants to help them survive and thrive. Check it out on your favorite listening platform. There is, and you have to keep yourself going and figure out. I mean, it's not that you have to, I don't call it work. I call it, do what you love and have fun and enjoy it and spend your time doing that. I think that's a big part of it is that. And some people are lucky. They spend their life doing what they love. Most people have a job, and so they do what they have to make money. And to me, retirement is when you have the ability to do what you love and you make enough money to keep you happy, right?
And have those challenges. And when you think about that too, same with the markets. I remember a client did tell me something, kind of as people were vaccinated and getting back outside. He said, boy, when this pandemic ends, we're going to have smooth sailing, won't we? I said, no. I said, I don't know what it is. I'm not going to even pretend to know what it will be, but it won't be smooth sailing. I know that. And so there's always the next thing around the corner it's what makes my business fun, I think. It's not always fun and joyful, but it's always interesting.
What are some of the biggest money mistakes you've seen people make?
Well, it's getting scared at the bottom. You think that if you own too much, that would be a terrible mistake. There are two things, I guess. One is selling at the bottom, and then because you're afraid. And you're usually afraid because you had too much at the top. So if you kind of can deal with how much risk can I take? Quote from Jesse Livermore is something like, you've got to take your stocks down to the sleeping level. In other words, what is it that would allow you to sleep even if the market dropped precipitously? And so if you don't do that, then what people do when the market drops is say, oh my gosh, I better sell because I have too much. And they're going the wrong direction. And so they're doing two things. One is taking stocks out when things are low. But what that usually causes them to do is, 6 months or 2 years later, they're buying when they're back up again and it feels safe. Of course, when it feels safe, that's never the right time. So it can just throw you out of whack. And so if you just stick to your objective, and when the market is high, you take stocks back to your objective. When it's low, you move it back up. Again, you feel more like a mechanic than an investor, but that can overcome that. The other thing that probably is potentially even more traumatic is having too much of one stock. And of course, this has happened, it can happen with technology. and you can feel hugely successful. I saw it early in my career with energy stocks. There were people who made fortunes with little energy companies. Remember one Canadian company, Dome Petroleum, and the guy, he bought it at a couple of dollars and it ran up to huge profits. And we tried to sell it. And he said, "Are you kidding me? This is our best stock. How could you sell this? Energy's going up forever." Imagine, trying to sell my stock like that. Well, what turned into a couple of $100,000 position turned into a few $1 million position. And by the end, he barely got out $20,000 or $30,000 because that little Canadian company became one of the big bankruptcies in Canada as energy turned around and did what no one thought was possible back in the early 80s. Energy became not a dying industry, but certainly not the growth industry that was thought about early in the 80s. And of course, technology, you could imagine the same thing. That people thought, back in the late 90s, oh my God, this is going to go. This is the new paradigm. It's going to go on forever. And the trouble is, certainly some of these stocks were great survivors, but think of the number of bankruptcies that went on with these companies that were formed out of people's garages and such. And I'm not talking about Apple and Microsoft and Hewlett Packard, but the ones that didn't survive, terrible. And think of the people who worked for banks that thought they were conservative because they were they were working for the bank. They were going to put their money in their bank stock. And 2008 happens and the whole thing collapses. And so those are the two biggest mistakes: getting scared at the bottom and then having too much of one position.
When someone sees their stock value skyrocket and essentially on paper they become millionaires and then they lose it all, what's the emotional response to all of that?
Well, I'm sure it's all over the map, but when we saw it happen, back in the 80s, they got mad at us, mad at themselves. They, of course, had other monies. It wasn't like they went bankrupt or lost everything besides it, but they were furious. And when I look back at that, there was no lesson learned there because they actually allowed it to happen again because they didn't have the humility to say, "I screwed up." And one of the other things that tends to happen when those stocks turn around, let's say you have a stock that turns into whether it's hundreds of thousands of dollars or millions, or for some people, it's their first investment. And it went from, think of the cryptocurrency guy that got lucky early on. I put $1,000 in and now he's got 40,000 and then it starts going down. Well, gosh, if you sold it when it was only 30,000 or 20,000, say it was down 50%, and you go, well, still at 20,000. The hardest part is to sell when it's going down. You always think, I'll sell it when it pops up a little bit. I won't sell it at 20, I'll sell it at 25. And the market almost is laughing at you at that point. It's not giving you that chance out. And so, I've always believed, take a little bit off the top, as stocks are rising, sell a little bit, and NVIDIA's tripled, take a little bit out. You can still root for it. That's the funny thing. People feel like, oh my God, I'm going to sell it. What if it goes up? Well, good. Say you had 10,000 in NVIDIA, now you got 30,000 and you sell 10,000. Now you're back to 20 and it goes back up. Good. Sell it a little bit more. There are other stocks out there. You can spread it around.
And what I like to do if I'm going to play in a high flyer game like that is I want to take my cash back out. So if I put in 10, I want my 10 back. Give me a little bit of profit. And now I'm playing with house money, so to speak.
Exactly. I love it.
At that point, even if you lose it, okay, at least you have your original investment and you have a little bit more and you can't complain that much. And that has saved me many a times. The other thing that I used to do and I haven't done and I probably should, it's just that the markets have been way too crazy. We used to put trailing stop loss orders in. And if, depending on the stock, whatever we set, if it dropped more than 10% or whatever, whatever percentage we put in, we were out. Like it triggered without us thinking. And that prevented you from the large loss. The problem is with the tech stops, they go up and down so much. You got to put a pretty big trailing percentage in so that you don't keep selling out too early. But it's one way to kind of play the game. And
I like that. And I don't do it for every stock. But what you can do also is do it for part of your position. Let's say you have Apple, and Apple's a big part of the market, but now it's gone up a lot. Now you've got a ton of it. You could do that trailing stop with part of your Apple position and figure, well, I'm going to keep a certain percent for the long term. But this extra move that it's made, I'll kind of put that trailing on, say you have 400 shares, you put it on 100 shares. And the other reason, the other way I've used stop losses is when I don't understand why it's going down. And I have to say it saved me back in 2008 because we did not know, at least I did not know the extent of what was going to happen to some of these bank stocks. But I knew something was going on that I didn't understand. Because if something was of value, in my opinion, say at $40 a share, at $30 a share, you're thinking, something's going on here. At $25 a share, you're thinking, I don't understand what's going on, and I'm going to set the stop loss. And I'm just going to move on to something else because at some point, the market is telling you, you're wrong. You better get out of the way.
And people try and fight the tide. I have found when the tide goes out of a stock, more often than not, it keeps going. And we emotionally can't let go.
And that's where the emotions are tough. And you think if someone who has humility and kind of isn't competing or feeling bad about it, I mean, we all face it. But you say, gosh, there are a lot of stocks out there. Why do I need this one? Move on to something that has a more comfortable trend, or it doesn't have the issues and problems that are causing this one to go down. We all face it, though. I could talk a good tune, but next week something will happen. I'm going, hate that.
Well, and I think part of it is the reality is for a lot of people, they have not experienced pain in the markets for 15 years now. And psychology-wise, people can't think that far back. And they don't realize how bad it can get and for how long. And, I mean, everyone keeps waiting for the shoe to drop and hasn't. So it's a question of when, not if, and how much. And those are all unanswerable questions.
Yeah. So far, you're right. The pain seems we keep kind of getting bailed out before the pain gets too real. I thought we were close to it last year because nearly for 9 or 10 months that market was going down. But just when the imaginary recession was about to appear and things were going to all of a sudden things get better. And of course, in the pandemic, it was 3 weeks. You were barely finished buying your toilet paper and the market was going back up again. And so you're right. We've not had one of those painful, real bear markets and where it's just bleeding you day after day.
So what are your thoughts? I mean, looking out at the markets today, I mean, no one's expecting a crystal ball, but is there anything that you're seeing that you've seen historically that brings concern or brings excitement?
Yeah, I think the couple of things that are out there that are certainly different, and these are my thoughts about it. First is interest rates. That for most of my career, if you went anti-interest rate, when interest rates are up, get out of stocks. When they're down, get in. Now, sometimes that meant when they're going down, the economy was bad, and you were contrary economy. You were getting bad economic news, but interest rates were going down. That's okay. It was a good time to buy stocks. So that's kind of my training. And so here we've had, short-term interest rates go, 0 to 5.5% or so in the last year. And yet the market's confounded that this year and gone up despite rising rates. My thought has been there is that historically 4 to 5% rates is about where the Fed funds and discount rate has been. And so maybe we're just back to normal, and the stock market may be fairly normal based on that. And so the worry would be if you go up much higher than we are, then my lessons from the last 40 years probably kick in. And the other thing to think about is long-term rates. Long-term rates are only right a little over 4%. So the long-term bond market, if you say that it's predicting anything, it's saying inflation is not that bad. If inflation was really at 4 or 5%, that long bond should be at 7, 8%, 6%. It's not there. And so the bond market's predicting somewhat calm. And I think that's why the stock market is up right now. So if there's something to watch, to say, beware, I'd say watch that long bond. It goes much over 5, 6%. That's saying inflation is not getting calmed. The Fed's going to keep raising rates, and eventually that market's going to hit a skid. And then, of course, you'd say, what about technology? I mean, technology is close to 30% of the S&P 500. Most of the time when you get that, you get a correction. And so I'm not predicting that yet, but I think, if you think that, 3 to 4% in a stock is about right, I would cut it, these, NVIDIA and Apple or whatever it is, back to normal position sizes. And that's not a prediction that Apple or NVIDIA is going down a lot. I think it's just good portfolio management. And so that's what I'd say about the, what should you do based on the chaos that I probably just described? Get back to your long-term objective. If you started the year at 60% and the market's up 20% and now you're at 68 or 70%, take it back down to 60 and take your long-term objective. This is not predicting a huge drop, but over time, you're better off selling when stocks are up, and when they drop, buy a little bit back in.
Have we had such an inverted yield curve in a long time?
We actually touched an inverted yield curve, I believe, in 2018. There was a lot of excitement about it then. And back then, it was just a lot of excitement. And starting in 2019, I think the market took off. And so there is this theory of when you have an inverted yield curve, that's showing that the economy is going to go into a recession. And so that's what many of these economists have been shouting about for the last 12 months. And you wonder, they're probably rooting for it, right? So, and there's an old expression, if you say it long enough, you'll eventually be right. And so eventually we will have an economic decline, and someone might look back at this inverted yield curve. But for me, it's why it's inverted. And to me, this inversion is because the Fed is fighting inflation and the long bond market actually believes it. They actually believe inflation is dropping. And so I would worry more if we get the opposite of it, of the inversion, and long rates go up because they're afraid of rising inflation. That would scare me more than this.
Interesting. Well, and nobody knows, right? That is the key. And I've learned the more people tell you something, the less likely it may happen.
And hopefully, if you haven't heard this before, it's more likely, because when I find that I'm saying the same thing that everybody else is, then I know I'm wrong. If I'm a little bit different, then sometimes it's right. But I guess the most important thing is to discount not just what I say about what might happen in the future, but what everyone else says. Stick to your long-term objective. That's more important than worrying about, me or anyone else, because my crystal ball tends to be as fuzzy as everyone else's too.
Is there anything that we should have talked about today that we didn't get a chance to?
The thing that I would, stress, and we've certainly touched on it, is that, I've become enamored with my experiences and how they've taught me lessons over time. But we all have different experiences, and we all have you know, fear and greed and love and heartbreak and all these different experiences. And we're tied by these emotions. They're similar to all of us. And I think we forget that. You know, I remember seeing a picture of my grandma and grandpa who talked about how sweet they were. And in the 1920s, they're on the beach hanging all over each other, just like you see today. And I'm thinking, oh my God, they loved and they had, you know, hopes and fears just like I do. And so I just remind all of us to learn from these experiences and remember we're all tied together by these emotions that have gone through since the beginning of time.
And that's all you can do, right? I mean,
that's right.
Understanding the emotions of the market and how you react, having a plan, sticking to your plan and staying the course. It literally what it comes down to.
Yeah, learning about yourself along the way.
And I think that was some of the biggest ahas I've learned along the way is to understand how you behave when markets react and learning to be prepared for that and be ready to go to deal with it when it happens.
It's great.
It's time to learn the secrets of life. What's your secret to living an abundant life?
Always looking at my challenges as potential growth, because that's what life is about, is learning and growing.
Yeah, and when you stop growing, you retire and then you pretty much die quickly. We didn't even talk about, like, how long do people really live in retirement if they have nothing to do?
If they have nothing to do.
What did you learn later in life that you wish you would have learned sooner?
I think it is that I wish I had learned that these challenges and these heartbreaks and painful experiences are to teach you. Not just the experiences, but sometimes the difficult people that come into your lives. I know it's a short answer, but they're sometimes our greatest teachers.
Life is happening for you, not to you. And so you just got to understand it. If you were to give an 18-year-old one specific piece of wisdom, what would it be?
It would be to expect the unexpected and embrace it and learn from it.
And that's all you can do, right? Because especially at 18, you don't even know what's going to happen. Everything you think is going out the window.
Including your beliefs, right?
Including it's that next shift. I think kids go through, I always look at the ages as a couple of shifts, and then the next shift is that 18 to maybe early 20s. And then after that, it'll be another shift. And then it's every 10 years, every decade on, you're constantly shifting.
I totally agree.
If people would like to learn more about you or the book, what's the best way for them to do that?
The book is, as you say, called Mellow Your Money, How to Surf the Market and Build Wealth Without Stressing Yourself Out. And you can find it at most areas, Amazon, Barnes & Noble and such. And the website is www.mellowyourmoney.com. And there I've got my information, my blogs and such, and anything you'd like to learn about me. And certainly you can email me too, and be happy to have some discourse along the way too.
Cool. And we will put that into the show notes. Thank you so much for joining us today.
Thank you, Rocky. It was really fun and great sharing with you. And I think your shows are fantastic too. I'm glad to be a part of it.
Thank you. What wisdom were you able to pick up from that discussion about becoming more mindful and effective with our money? One of the big takeaways for me is the importance of understanding our emotions around money and investing. This is something I still struggle with. And it's hard for us to master ourselves and stay centered when the markets get turbulent. And right now, they kind of are. And it's hard to make those choices and learn when to let things be and when to take action. I love about embracing the unexpected and viewing challenges as opportunities for growth. It's really hard to do in the moment, but then we all reflect back and we go, oh yeah, that was actually good for me. So ask yourself, how can you avoid common money mistakes? How do you avoid selling in fear? What's your real risk tolerance of the markets? And how in touch are you with your emotions about financial choices? Thank you for listening. And who do you know who would like to listen to this episode with Mick? I'd appreciate if you'd share it with them. Next week, I've got on Chris Sirach, and we're going to talk about uncovering your true self and that path to figuring it all out. Thanks for listening. Have an abundant week.